FY18 has ended. This was a year which started with a lot of promise, and at one point the indices were up close to 20%. However, after the imposition of the long-term capital gains tax in the budget and the subsequent increase in bond yields themselves, the markets underwent a correction and we ended the year just about 10% up on the index. The character of the market also changed sharply. Beginning of the year, the risk taking was on the higher side. The mid cap part of the market was doing very well. Towards the end, the scenario changed. The risk aversion came back and the focus on high quality, high growth style re-emerged. This style, which was under a stress over the last 2 years, finished the year being the focus of the marketplace. The world is seeing a lot of trade barriers going up. What is happening is that several countries, in the quest to quicken their own domestic growth rates, are increasing trade barriers. It is already impacting larger traded commodities like steel and aluminum. But even in the Indian context, our IT services are facing a higher degree of pressure in the US. The cost of doing business is going up. That clearly is something which is not good for global trade. So while the countries are doing it to improve domestic growth rates, yet if overall the global growth rates go down, it is not going to help the participant countries to deliver higher growth. As we move deeper into the new fiscal 19, the focus on elections and the uncertainties regarding it would also increase. Elections on the positive side do a few things to the economy. The government spending is usually on the higher side, given the budget and the higher than expected deficit. That's clearly the focus of the current government as well. What also happens is that money spent by the political parties themselves and the individual contestants is also high, and de facto the economy as a whole gets a whole lot of more cash flows. M3 goes up in such a period, and the consumption part of the economy does very well. So sectors like consumer durables, autos, FMCG, businesses in finance which focus on this part of the market tend to do very well. That should be the enduring theme of this year as well, given the fact that capex is still taking time to revive and the export part of the economy is facing a stress on renewed focus on domestic space by most of the larger trading nations. Lastly, this is a very opportune time. Markets have corrected after the budget. In fact, over the year, the overall returns in the equity markets have been a tad below the earnings growth that we expect to see for FY18 itself, which means that on the index valuations have corrected. And at the same time growth is expected to move up. Quarter 3 results were in line with expectations at 12.7% EPS growth on the Nifty. Going forward, we believe quarter 4 would be very strong. We should see growth in the vicinity of 23% on the Nifty on a YOY basis, and the trend will continue into the new year as well. Fiscal 19 over 18 seems like 18% kind of growth rate year. Hence, at this juncture, when valuations have corrected, and like I said before, a tad more than uh, uh, the earnings have moved more than the overall markets. We do believe the market is presenting a good opportunity for fresh investments at this point in time. In terms of style, we really believe a style focused on high quality, high growth businesses should tend to do well, given that risk aversion is expected to stay high in the marketplace. Thank you.